Hello, hello. Welcome in, everyone. Welcome in. We are so excited to have you here with us today. Let everyone transfer in. Awesome. Awesome. Well, welcome to the Be Your Own Bank Challenge. I am Keisha Jones, and I'm excited to welcome you all in. I see a few familiar names. We've been touching base with you all, so we're excited that you all are here. I'll be your co-host for today. So I'll be in the chat, just making sure that we keep you all engaged. And I have the honor of introducing our speaker and our leader today. So I would like to introduce you all to Richelle Dickerson, and she is the CEO of Rayma Financial Solutions, based here in Virginia Beach, Virginia. If anyone's in Virginia, feel free to, shout it out. Excited to see some people present. So, Rochelle, she is an expert. She's a certified life insurance broker and a $1 million roundtable award winner. She's been in the business for 30 years. So, she is your go to person for all the details she'll be talking about today. And on a personal note, Rochelle is also a single mother and a caretaker for her mother, her loving mother. So, without further ado, I'm going to pass it over to Rochelle so she can take us through the Be Your Own Bank Challenge today.
All right. Hello, everybody. Hello. Welcome. Let me put my glasses on so I can see who is in the house today. Let's take a look. Hello, Claudette. Welcome. Who else? Miss Jacqueline, you got your camera on, looking beautiful. All right, is it Miss Shima? Did I say it right? Mishima, hello and welcome. All right, Mishima, you're making me want some sushi. I'm feeling like some shrimp. I love your name. It's beautiful. It's beautiful. All right, so listen, you all. I am going to be talking about how to be your own bank on today. So listen, this topic is a life-changing topic. It is the way to think like a bank, how to think like your personal finances. You are your own bank, right? And once you adopt this philosophy, you will never be the same. Your entire idea of how to handle money, how to grow money will never be the same. I first stumbled across this concept, I want to say at the beginning of the pandemic in 2020. I was in the life insurance industry and we were selling these policies that had high cash value. Now some of you are like, what is a cash value? Well, that's the money you can withdraw from a policy or you can borrow it from the policy. And all I'd ever seen was stinky life insurance, quite frankly, up to that point. It doesn't have much cash value and it only pays if you die. And if you borrow from it, your death benefit will decrease in value. So when I first heard of this, I said, y'all lying. Because all I know about life insurance is that it pays if you die. And if you borrow from it, you're going to be like my grandma. And she borrowed from it. She only had $3,500 left to bury her with. And she borrowed so much money, she didn't have any life insurance left. So I said, as far as my grandma, my mama, and my parents are concerned, they said you don't borrow money from a life insurance policy. Has anybody ever heard that? That you don't borrow money from a life insurance policy? Am I the only one? Wave your hands at me if you've ever heard that, right? Yes, ma'am. Yes, Keisha. So that was my experience, y'all. Then I heard about something called the rich man's Roth, where people like Waka Flocka and Disney and J.C. Penney. I'm talking about the Walt Disney and J.C. Penney and people like what's his name? P something. He's a music producer. I can't think of his name. His name begins with a P. I can't think of his name. These jokers was taking large loans from their life insurance policy instead of going to the bank and taking out a business loan. These jokers went to their life insurance policies and were taking out loans large enough to start businesses. Waka Flocka does it to leverage and do marketing for his business. Disney did it to buy the land in California. And why did they go to their life insurance policy as opposed to going to the bank? Well, the bank charges you high interest on your loan. But with a life insurance loan, we know how to wipe out the interest on a loan, which means you can borrow money and not pay interest. What? Okay, so I know I'm going way left, right? But that was the concept I learned. And I started digging into it, and I found out there were life insurance policies that have stocks inside of them. The stock market inside of a life insurance policy. And I said, what the ham sandwich is this? And why have I been in the industry since 1992? And here it is 2020, and I'm just finding out about this. I've been beating the pavement all this time. And you mean this has been here all the time? Then I learned that this joker named, what is his name? E.F. Hutton, Ask E.F. Hutton, invented this policy for rich people where he put stocks inside of a life insurance policy because it grows money tax free. Tax free. Where do wealthy people put their money to grow it tax free? Besides inside of a trust. Life insurance, because life insurance forms a trust. And it's a place where the IRS can't see it. And if you get in trouble, you're an entrepreneur and you owe taxes, it's tax time. You can put money inside this joker and the IRS can't see it because it's in the death benefit and it's growing according to the stock market and it's taking no losses on the stock market because the life insurance company guarantees your principal and that you'll never lose any money. I was like, I was mad, y'all. I was mad. You know why? Because some of my colleagues, brown like me, male, had been doing this since the 80s, but they didn't tell everybody. So I was mad at them. I was mad at the industry. I was mad, right? So being your own bank is borrowing somebody else's money to make money. So borrowing money from the bank to make money, borrowing money from investors, getting investors using their capital, right, to make money, right? So that's being your own bank, using someone else's money to make money. Okay. So that's the concept of being your own bank. And as I began to grow and learn more about the industry, I found out that they're not just life insurance policies that do this, but that there are annuities that can do this. There are investment accounts that can do this, where you can leverage the investment company's money, keep your money in the investment account, borrow cheap money from them, use their money to make money while your money grows. And listen, you don't lose a dime because the insurance company will guarantee that you don't lose any money on the market. Listen, so because of what I've been through, the financial segregation, yes, you know that black folk, we were segregated. But did you know that there still exists a financial segregation in our industry where if you don't make a certain amount of money, even me as an agent, if I don't make a certain amount of money, I'll never see these products. If I don't make a certain amount of money or hit certain production level, these products would not be exposed to me. If my clients didn't have a certain amount of cash saved or have certain income levels, they would never see these products. And let me tell you something, the righteous God in me was angry. I was mad because there are so many people, good people, who have the discipline to save, who actually qualify for these programs, but they won't get them because of the segregation that exists in the industry. So now you see, this is my passion, exposing it to everyone so that you have a chance to make a choice. You'll know. And then I talked, I have a client who's also a girlfriend of mine. And she said to me the other week, she said, Richelle, I've been going on these Zoom calls and I've been seeing these jokers go from 0 to 10x or 0 to 30x. And I know they got something that we don't have. You finally showed us what it is that they have that we don't have and opened up the door for us. I said, yes, ma'am. So now you understand where I am coming from and why you decided to get on the call. So, Wanda, you are in the right place at the right time with the right person. Keisha, Jacqueline, Mashima, Claudia, you are in the right place at the right time with the right person. Now, yes, Keisha told you that I'm a certified financial planner. I'm a life insurance broker, but I'm also a financial advisor. So that means I am obligated by law to do what's in your best interest. Are you picking up what I'm laying down? So, with that being said, listen, hold on, y'all. Keisha, what do you see on the screen? Because all I see is myself. You can chime in. All I see is myself. I can't see the PowerPoint. Can you
I
see
see
the
the
PowerPoint? You do?
yes.
All I see is my beautiful face. I can't see it. I
Okay.
don't know, y'all. I can't see the PowerPoint. Keisha is my help, y'all.
Can everyone put a thumbs up if you can see Rochelle's screen?
Can y'all put a thumb us up in the chat
If you
if you can see my PowerPoint? Somebody help us out here. Keisha,
the
did anybody put a
spotlight,
thumbs up?
um, I'm looking at the videos. I don't see anyone doing it. So
No. So that means you guys cannot see my PowerPoint. You can't see it?
you can.
You can.
Yeah. Can you put a thumbs up? Do you mind putting a thumbs up? Because I don't know if anyone can type it in the chat because it's
Can
disabled
you
for
can
them.
you hear me?
Yes, we
Oh,
can.
I hear somebody.
There we go.
Okay,
Thank you,
so
Mashima. So they
Thank you,
see.
Mashima.
Do you see it now, Rochelle?
You see it now? Okay, now I see it. Okay, so there should be a picture of me and Keisha. Do you see that?
I see
Yes.
that, but
Mhm.
my
Thank you.
name on the board is not Keisha. I'm not Keisha Jones. I just want.
I don't know why. We could change that. Who
Yeah, I
are
I
can
was
you?
change it for you.
Who are
I was
you?
I was trying to change it, but I
Who
can't.
are you? Who are
My
you?
my name is Linda Morrissey.
Hi,
Thanks for
Miss
joining us, Linda.
Linda. I know you. Hi, Miss
I
Linda.
know. How
She
are
said,
you?
I know from Prime Plus. How are you?
Yes.
Thank you for
Good,
being
good,
here.
thank you.
Kisses, love. All right, so listen. So we're talking about being your own bank. I told you my driving passion, right? So being your own bank is the ability to or leverage a life insurance company's money, specifically on this call. We want to use their money to boost our retirement account. We want to use their money to boost our life insurance and to grow money tax free. We want to use their money so that our money never dries up. We get paid a pension for the rest of our life and then pass that same pension check onto our children and our children's children or onto our spouses, right? So we want to leverage because life insurance companies, they have a lot of money, y'all. Y'all know they have a lot of money. And when you have an annuity or you have a life insurance policy, it forms a sort of trust, which means it avoids probate. So if you have an annuity and you pass away, Your children or whoever you left it to, they don't have to worry about the government getting the money first. It goes straight to them. Do you picking up what I'm laying down? So
Mhm.
a life insurance and an annuity are powerful tools to use to be your own bank. Okay. So we already talked to you about who I am and what I do. So I'm not going to go back through there, but I want to show you my team. I love these people here. You hear me? Bill is my other business partner, Bill Brown. He's been in the industry since for 40 years, longer than I. Listen, if you know Black history, there were two life insurance companies that were black owned life insurance companies in the United States of America. The first one was Atlanta Life. The second one was North Carolina Mutual. Bill was the vice president of the historic North Carolina Mutual. So, what's so significant about that? Guess who covered Martin Luther King, Medgar Evers, Rosa Parks? Do you know that once you join the civil rights activist movement, life insurance companies would not cover you because you were considered high risk? Where North Carolina Mutual and Atlanta Life, the black owned life insurance companies, were the only ones that would cover the civil rights activists. So you think about how much history is inside of that. He was also the vice president of AXA Financial, which is a group of brokers, of financial people who sell stocks on Wall Street. Okay. So he and I together make a power couple. So if you decide, say, hey, Richelle, you know what? I like that be your own bank thing. I want to take a look at an annuity or whatever it is you say you want to look at. Him and I together, you get us both to look at your finances and make sure you get the most money. Hear what I'm saying? We shop companies for you, match you up with the biggest money you can get in your account. I'm telling you, all right? Pat Envoy is another one of my business partners. He structures specifically life insurance policies that have stocks inside of them that pay the largest amounts and take the most growth on those stocks. And people like Ben and Killian, and I have also have Cassie. These guys love structuring growth annuities and growth accounts. So they're on the cutting edge of what's happening on the market, what is paying the most there, and what will take zero losses. All right. Then you have Keisha. Keisha's right by my side. She lives here in Virginia Beach with me. She's going to be reaching out to you. She's warm and wonderful. She's a woman of God, okay? So you are, and so we all love God, and we all hold people in high esteem. We put people first. You understand what I'm saying? So this team, and is we're multicultural. So that means we can get in and out of back rooms. You picking up what I'm laying down? So I absolutely love my team. And this is our team, our inner circle at Rayma Financial Solutions. All right. So I have to make this disclaimer. This presentation is for information only, only for educational purposes. It is not to substitute for personal financial advice. It's not a substitute for tax advice, personally, financial advice, personally, or legal personal advice. That can only be done one on one in a personal room by law. So even on this call, you'll have a chance to talk. You'll have some later coaching, but we're going to ask you, do not tell us any of your personal financial information, and do not take this presentation and then try to use the information on your own and then blame us. Okay? By watching this presentation, you have released us from all liability from your use of the information that you are about to see. By viewing this presentation, you have agreed not to hold Rama Financial Solutions Incorporated, any of our affiliates, or anybody on this Zoom call in the chat liable for anything that you do outside of here. And the church says, Amen. All right. So now, with that being said, we can continue. What does it mean to be your own bank? Be your own bank is simply the mindset to leverage other people's money to make money. Other people's money, other people's, the bank's money, the life insurance company's money, another institute's money, an investor's money to make money. It is the mindset to leverage. Examples of leveraging: matching money. If you have a 401k, a 403b, or any kind of work pension plan, and that job is giving you matching money, you are getting free money. You are leveraging their money to multiply your money. This is something that I had never heard about until 2023. And that is something called premium bonus money. This is where the life insurance company gives you a bonus for transferring your money into an annuity. Bonuses run from 5% all the way up to, catch this, 30%. Depending on your ability to save money and not touch it for 1 year. If you have the ability to save money and not touch it for 1 year, you can qualify to have a life insurance company pay you bonus money on what you put into an annuity or a growth account. Woo, child. When I heard that, I wanted to get up and shout and do the happy dance. Like the preacher, like somebody at church hit the organ. I said, what you talking about? Okay. The second way to leverage is earning something called dividends. Listen, if these are new terms for you, write them down. Dividends is when the company pays you a portion of their earnings. So a dividend stock, right? So let's say you bought Coca-Cola. That's a dividend paying stock. And Coca-Cola earned 8%. So they paid you 7% dividend at the end of the year. Or maybe they pay it to you monthly or quarterly, depending on that stock. Life insurance that pays you dividends. A mutually owned life insurance company means you are a shareholder as a policyholder. So you're going to get a dividend statement, which means they're paying you a portion of what you earned by being a policyholder. You can have those dividends paid to you monthly off your life insurance policy or quarterly, or you can take the dividends and stick them back in your life insurance and grow the cash tax free. Dividends, people. Dividends. Do you hear what I'm saying? And also interest. Earning interest on your cash. I'm going to stop and say this. If you have a savings account at the bank and they are paying you less than 4% interest, you need to move your money. Find yourself, write this down, people. I'm dropping gems. A high yield savings account. Type it in the chat so other people can see it. Type in the chat high yield savings account. High yield. Those are the two words you want to step in the bank and say, I want a high yield savings account. And if they have one, you'll automatically be exposed to something you hadn't seen before. High yield savings account. Don't settle for anything else or a money market account. Your goal is 4% interest or more. Put that in the chat, 4%. Now I want you to keep typing in the chat. In the chat, Capital One, Sally Mae, Goldman Sachs. I just dropped three. There are a few more. If you're interested in a list of high yield savings accounts, email me and I will email you the brochure that we have that has a list of high yield savings accounts. If you don't have one, you're being robbed. How? Because the bank is charging you fees for for whatever they make up. Let's make up a fee. A maintenance fee. Yeah, that sounds good. Okay. We'll call this a maintenance fee, right? And we'll do it whatever fee we think we like today, right? That's highway robbery, people. Okay? And if you don't know better, you can't do better. But now that you're sitting in front of me, you know better. Email me. Keisha, you can drop my email in the chat. Rhema, Rhema, financial coaching at gmail.com. Say, Richelle, I was on your Be Your Own Bank challenge. You promised me a brochure that has a list of high yield savings accounts. Send it to me. It's just that simple. Guess what? You just got paid. Staying on this call for 10, 15 minutes. You just got paid. All right. Life insurance that has cash value, high cash value, not them little 2% policies, the burial policies. Back in the beginning of North Carolina Mutual and Atlantic Life, that's all we had, burial policies. Back when I started in the 1990s, they redlined us as life insurance agents. They said you can only sell in this zip code and you can only sell term and whole life. And both of them stink. Those premiums smell to the high heaven. But that's all we knew and that's all we have. So I have to apologize to you. From 2003 all the way up until now, I am so sorry. But that is all we had. We were segregated. Now we have insurance, life insurance that has stocks and dividends and all kinds of sweet, juicy borrowing power, cash growing in it. And yes, you can do this for your grandbaby, your baby, your child. You can take a little bit of money and put it into one of them dividend paying life insurance policies. Ooh, honey bunny. You talking about teaching financial literacy. If you're interested in that, send me an email and Keisha can drop it in the chat. You can just jump straight on a Zoom. Tell me your baby's birthday and how much money you want to put in. Let's pass on generational wealth. My grandma Belle would be so glad that I told y'all that. You hear me? Equity lines of credit. Don't die with the equity still left in your house. The bank wins and you don't. I talk to 50, 60, 70, almost 80-year-olds all day. They say, Richelle, I've been paid off my house. I'm like, you did? You only made $60,000 a year and you worked for 20 years and paid off this house in Norfolk. Yes, I did. I said, how much equity do you have? They say, look at me and blink their big old eyes and say, I don't know. I said, well, you have a homework assignment. You're going to find out how much this house is worth and how much you could sell it for. And you're going to go to the bank, or if you're still paying mortgage, you're going to find out how much equity you have. That is money that you can form what's called an equity line of credit, and you can be your own bank using the equity in your house. You want more information on that? We can have a phone call. I believe in prosperity for the community. And the Lord told me the more I give, he told me I can't outgive him. So if I bless you, he multiplies it back to me 100-fold. So I can bless you. Yes, I can. The other thing is something called a trust. Put your property, your bank accounts, your life insurance, every asset that you have, even if you have a car and you have paid it off, you own it free and clear, put it all in a trust. Why? So it doesn't go to Uncle Sam. Because Uncle Sam, when you die, that's the first thing he's going to come for. Protect your family. Put your assets inside of a trust. Well, how much is it going to cost? Anywhere between $500 and $3,500. And we can refer you to some places in your area. So reach out to me if you're interested in knowing where to go. You need an inside tip too, because if you go to the wrong law firm, they're gonna see you coming. And they may try to overcharge you. So you want somebody that has your back and can tell you before going in how much you should and shouldn't pay. Trust me on that. Business systems that create passive income. Keisha and I are working to set up business systems that just crank out cash without us doing anything. Right? These are digital business systems. Okay, we're not going to go into that. That's for another workshop. But that's all called leveraging. This would be a good book. Let me tell you something. Okay, now listen. Before you can leverage even the life insurance money, you have to already make this first step, this first power move. The first power move that you must make is you must be a saver. The Bible says, go to the ant, thy sluggard, and consider her ways, how she saves her money. I'm going to say it this way, in the winter. And then in the spring and summer, she gathers. And in the winter, she lives comfortably. In the winters of your life, you have to have enough savings that will last for the rest of your life. So, in order to qualify for one of the accounts that I share with you, you must have 3 to 6 months worth of emergency savings in your own personal bank account that you don't need to touch. Now, no financial advisor will ever touch that money. That needs to be money for you. Then the company will take separate money and begin to bonus it. But that money needs to be there in your account at all times. All right. So the first place you put money, well, if you're a tither, then you give it to God. You give something to God, right? And then get tied to God, you tie to yourself. 10% of all your earnings go into a high yield savings account or a money market account, not a CD, because they lock your money up. That's not accessible. Okay. The second place you must have in order to be your own bank is a passive income bucket. This is a place where you put a portion of your money and it's going to create money paid to you that you don't have to work for, i.e., it's going to create a pension for you. It's going to create a social security check for you. Now, this is passive income. You don't have to be 70 years old to get it. You can be 28. Simone Bias is financially independent. She has passive income bucket. Simone Bias, the GOAT, she's the gold medalist. She has real estate that creates passive income. She has businesses that create passive income. She has dividends, start paying stocks that create passive income, and annuities. Not the cheap, stinky annuities that you get from the bank, but high end elite annuities. Okay. So you must have a passive income bucket, something that's going to, you set it and forget it, and then you can turn it on and it'll pay you for the rest of your life. After you get your emergency funds, that's the floor. That is the security, right? Because if you're in a car accident, you need the money to fix that. If there's some kind of storm and it hits your house, and you got a big hole or the lights go out in your house, right? You need money for emergencies. So that's the foundation. On top of that is a passive income bucket. That's the bucket that says when that bad boy hits this point, I'm going to turn it on and it's going to pay all my bills. I don't have to work anymore. That bad boy is going to pay all my basic expenses. And I'm going to grow it big enough so that I become financially free. And it's going to pay me every month or year. It's going to pay me so much money, I don't have to work anymore. And I can travel and do what I want. I'm free, right? So your emergency funds, then your passive income bucket. Then, only then, after you get those two buckets straight, then you go to the investment bucket. This is where you're going to take risk. This is when you begin to buy real estate because it may or may not go well and you could lose your money. This is where you can buy stocks that when the tariffs hit or whatever happens, you lose your money. This is where you're going to take the risk. But you don't risk your emergency funds on the stock market. You don't risk your passive income or retirement money on the stock market. These two buckets have to be off the stock market. And you can't flip it. You don't go putting your bill money on Robinhood or buying crypto with your bill money. If you flip this, you're going to be broke, busted, and disgusted. It does not work. It'll never work. Emergency funds, passive income, investment. In that order, don't change it. Don't double think it. It's a God principle. Don't mess with it. Just do it. Y'all hear me? Somebody
Yes.
said yes. Thank you. Thank
Yes.
you. All right. So now remember, I told you,
Yes.
I promised you that this was a challenge. So that means we need to test your knowledge just a little bit to see what you picked up. Okay? There are, here's your question, just like Bob Barker. And whoever is the first person to answer this question correctly, I am going to send you a gift. Keisha, I don't know what that gift is going to be just yet. I'm thinking it's going to be my ebook. I'm thinking it's going to be, I'd love to gift you something that is going to make money for you, right? Because you came to this call because you want to grow financially, right? But I want to give a gift to whoever paid attention. I want you to name for me, I'm going to challenge you, 4 places where you can put your money and it will create a passive income for you. Type in the chat 4 places where you can stick your money in there and it will create passive income for you. Now, Keisha, I'm going to pin you up here with me, and I need you to look at the chat and tell me who answered and what they said. Come on, y'all, let's step up. 4 places to put your money that'll create a passive income for you. What is a passive income? That is where you put your money in there and it just starts paying you either a dividend check, it'll pay you an income check, it'll just start paying you. Where are those places? Come on, y'all.
My chat isn't working, but one of us a money market is
Oh,
Claudia.
who's that? Hi, Claudia.
Claudia. Yeah, my
Okay.
chat
All right.
isn't working.
Oh, I need 4 places, Miss Claudia. 4. Okay. Does
Well,
anybody have 4? Raise your hand. I tell you what, instead of speaking out, because raise your hand if you think you got it. Raise your hand if you think you got it.
One more. Savings. No. High yield savings.
Okay. All right.
Beginning.
All right. So since everybody doesn't have it, I'm going to continue on and I'm going to ask it again. And I want y'all to pay close attention. I'm going to give you another chance. All right? Let's keep going. And I'm going to give you another chance and I'm going to come back and I'm going to ask that same question. All right? Okay. Let's keep going. All right. So here, okay? So the first bucket, the first step to financial independence, and if you're already financially independent, financial freedom is to always maintain 6 months or more worth of emergency cash in a money market account or a high yield savings account. It must be something where you can get your hands on it within 48 hours. And if you plan to leverage a life insurance company's money and you want to get a bonus where they'll pay you 20% interest or more, that is the marker. If you have at least 6 months worth of savings, you qualify. If you have less than 6 months, the next marker is 3 months. If you have at least 3 months worth of savings, then you qualify for a smaller bonus, 5% to 15%. Okay? If you have 6 months, then you qualify for the big guns, 20% to 30%. And that can be transferring your money into an IRA or an annuity or a growth brokerage account or whatever, and they will pay you. They want to see that you have enough savings where you don't have to touch what they pay you for 1 year. That's the catch. They're going to pay you a giant amount of money. They need to know that you can go for a year and not touch it. So they need to know that you have enough savings out here where you can set it and forget it for a year. So that is the reason why. So that's the first power move. Okay? All right. So let's talk about that first power move. Where are some places that are liquid cash where you can save that money? It can be in a life insurance policy where you have a good amount of cash value. I actually qualified somebody last week who didn't think she would qualify. And I said, how much cash value do you have in that policy? She said, I had that policy since, what she say? 19 something. I said, you've been paying that policy since 19 something. And then we looked, she had over $10,000 in cash value. She just forgot about it. So she qualified for a big bonus. The other place is the money market account, right? Money market means you participate with the bank and they pay you more interest. And then the second place, oh, look, this little, you can take a picture of this because these are some of the places. These are some of the high yield savings account in here. Neiman Marcus, Goldman Sachs, SoFi, Capital One, Sally Mae. These are some of the high yield savings that you need to look into, right? Okay. It can't be a CD because a CD locks your money away unless it's matured and you can get it all without penalty, then it counts, right? So that's where you start. All right. The second power move is that second bucket is a place where you can put your money and it'll create income. Now, this one's going to be a surprise because a lot of folk just haven't heard of this. And this is an indexed universal life. Take a picture of this slide or write it down. These are the places that we'll talk about today. An index universal life. Index is the stock market. That's a group of mutual funds, the S&P 500. Those are the top 500 companies in America. The Russell 2000, that's the top 2,000 companies in America. Bank of America funds, JP Morgan funds, right? The NASDAQ, those are the tech stocks. You will find those are called indexes. Anytime you see the word index or indexes, that means there are stocks inside of the policy. And this particular life insurance policy is the policy that has stocks. Index universal life. Now I didn't come to really do a deep dive into it. If you want to know more about that policy, Keisha, drop it in the chat and book a 30-minute Zoom call or a phone call with me, and I can go more into it. But an index universal life, you can pay into it for 10 years. You need at least 10 years of monthly premiums, and they can be modest, $200, $500. If you're young enough, $100. $1,000. It depends on you. And then in the 10th year, you can turn on a lifetime guaranteed income, tax-free income, where the death benefit, we can even reduce the death benefit at that time to dump the death benefit money into your income. It's a sweet, unique policy. Now, can you go down the street to Allstate and get one? No. Only people such as myself who are trained to structure these policies. These policies they're handmade and they're personalized. So somebody who can put their hands and you feel comfortable enough to tell them how much you want to put in and tell them how much you want to get back and when. We structure these policies. So if a person doesn't know how to structure these policies, they will rip you off, 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 off. I wish there was an echo. I have seen people who came to me and said, Ms. Richelle, I took out this Index Universal Life from XYZ company, and I've had it for 2 years, and it doesn't have any money in it. And I looked at it, and that joker that structured the policy maxed out the death benefit and overcharged them for the death benefit, so it ate up all of their cash. So if you get the wrong agent, you're not going to be your own bank. You're going to be their bank. They're banking off you. You ain't banking off them. So you have to get somebody who, like myself, you can trust, who will teach you what they're doing and how to make sure you got a lot of cash. The second place where you can put money into it is called an annuity. Okay, this is the second power move. This is a place where you can put money in there and it'll create a passive income. So annuities, we talked about the index, the word index, that's what it means. Now we're on annuities. So what is an annuity? An annuity is a place where you put a lump sum of money and it creates a lifetime income for you. So it'll pay you for the rest of your life. The money will never run dry. These are life insurance products. And the life insurance company guarantees that you don't lose a dime. And there are some annuities. I don't know if I want to go into that. But these particular annuities, the ones that we do, they're guaranteeing that you never lose a dime in the stock market. You take stock market interest, so they'll pay you, and they pay you bonus money. Okay? So annuity is a play. The annuity is the same as a pension. The annuity is not a 401k. A 401k is a chunk of money that can be lost on the stock market, right? A 401k doesn't automatically turn into an income. Now, at the end, when you retire, you can ask them to turn it into an income. I wouldn't recommend it because they lowball you and they tax you up the gazoo. So you need to get on a Zoom call with me. If you have a 401k at an old employer or you have it and you're about to retire and you don't know what to do with it, you don't want to keep losing it on the stock market. You don't want Uncle Sam to take 30 to 50% out in taxes. But you want to bonus it, you want to grow it, then you need to get on a Zoom call with me. Okay. So the third place is real estate. This is where you buy a piece of property, you get a rental company to manage it. It's not passive income if you're waking up in the middle of the night because your tenants don't have lights or their toilet bust or they got cockroaches or whatever. You got to deal with all of that, right? It's passive income when somebody else is dealing with that and you're just collecting the rent. The fourth place is a dividend paying stocks. Visa, Coca-Cola. If you want a list of dividend paying stocks, we can help you with that. These are places where you put your money and then you own a piece of the rock and then they paying you every month. Dividend paying stocks. Okay, 1, 2, 3, 4. The fifth place is to have a business system that just pays you. You create it, you set it, and you forget it. Right? So that's a business system that just pays you an income. In my industry, we used to call it a toll booth. You know how you drive across in the highway and everybody has to drop a dime in order to drive on your road? Hello. Okay? So I just gave you a few more places that create passive income. Okay? All right. So, trivia. Don't want to ask that question because I haven't really asked it. All right, so here's your second chance, y'all. Now, what are some of the safest ways to create passive income? Here are your choices: CDs, money market accounts, high yield savings accounts, dividend paying stocks, index universal life insurance policy. Name three places where you can put your money and it create passive income. Now, there are only three correct answers on this slide: CDs, money market accounts, high yield savings accounts, dividend paying stocks, annuities or self pensions, index universal life insurance policies. Name the correct three places. Raise your hand if you think you got it. Here's the challenge. I'm going to stop sharing and see you. Keisha, if you spot somebody that raised their hand, you can wave your hand or you can put your hand up in the chat. Oh, did I stop sharing? Do y'all still need to look at that slide? Three places where you can put your money and it will create a passive income. Look at this slide and pick the correct three. Keisha, do you see anybody who raised their hand? Jackie, Linda. Who else is on here?
Not
Some of y'all
just yet.
dropped off?
Yeah,
Nobody raised their hand
Claudia
just yet?
still.
Who's on here?
Jackie, Linda, and Claudia still with us.
Claudia still with us? Okay. Anybody? Anybody? Miss Linda, you look like you got it. You trust yourself. You leaning in. Claudia, you got the right answer?
If you're trying to
I'm
speak, you're on
sure
mute.
about two, but I'm not sure. I two for
Not sure
sure,
about
but the third one I'm not sure.
third one, you're not sure. Good job, though. What about you, Jackie? Jacqueline? You think you got it? Jacqueline, were you listening? Did I catch you off guard?
High
I
yield
told
savings.
y'all came to the challenge. That means y'all got to work and think.
Miss Linda is gonna wants to say something.
Miss Linda, do you have it?
Well, I don't know, but I know my chat is not working. So
Okay.
I have
Mm-hmm.
high yield savings. I have annuity
Uh-huh.
and dividend paying.
You got two of them. Good job. All right. You got two of them. So the two that you got were high. What was it? Give me
High
the three
yield
again.
savings,
Uh-huh.
annuity, and
Mm-hmm.
dividend paying.
Annuities and dividend paying stocks are correct. A high yield savings, the bank is not going to turn around and send you a check every month. If you put your money in a high yield savings, you can guarantee that. So it doesn't
Okay, so
instantly create an income for you. But yes, you need to put your emergency funds there. It's just
mm-hmm,
a parking garage for
mm-hmm.
your emergency money. And if you make sure it pays 4%, the money won't decrease in value. Because listen, the cost of living goes up by 5% each year, minimum. So next year, I say I paid $1 for this Deer Park water. Next summer, I'd have to pay $1.05 because the price went up by 5%. So that means the cost of living is increasing every year by 5%. So if your money is sitting in the bank and it's only growing by 2%, that means your money is decreasing in value every year by 3%. So
Mm-hmm.
your money has got to keep up with the cost of living increase. Well, else your money is decreasing in value, right? So a high yield savings account, they're not going to just turn around and say, "Hey, you know what? We're going to pay you a retirement check for the rest of your life." That's not going to do that. Okay.
Okay, so then
Mhm.
would the third one be the real estate rental?
That is true, but it's not on this list. But that is one that will pay you rental.
Mm-hmm.
Absolutely. Absolutely. So I'm going to tell y'all that's the index universal life. The only kind of life insurance that will pay you an income for the rest of your life. Dividend, the life insurance, you pay off the life insurance and it'll pay you an income for the rest of your life.
Okay,
So
index
Yeah, so Miss
universal.
Linda, write Miss Linda down and make sure I send her a gift. Miss Linda, you're a Prime Plus. I might bring the gift to you.
Mm-hmm. I'll be
All
there.
right. Yeah, I'll be there, All right, good job. Good job,
Okay,
everybody.
so index universal life. I need to know more
Yes,
about that.
it'll pay you a guarantee. Yeah, that's a new one. Not everybody knows about that one. Okay. Look at it. Take a look. This is an illustration. Can you still see my screen, everybody?
Yes.
Yeah.
Okay. So this is an illustration of an index universal life insurance policy. Okay. So they're called IULs for short. Now, you can put any amount of money you want to put in it. So you can have a baby and put $20 a month in for them, right? You can use it as a retirement plan and put $1,000 a month or $1,500 a month and use it as a tax-free retirement plan. That's what I do because I'm an entrepreneur. So I don't have a 401k matching, right? So this is how I got this house that you see me sitting in. I use my life insurance policy. So because I bought a car, Miss Linda, when you see me drive up, I paid off the car using my life insurance policy. And I can teach you how to be your own bank with this policy, okay? So, this is a couple that decided that they wanted to keep their matching money in their 401k. And they were putting in 10% of their income into their 401k. But then the market dropped and they lost their money on the stock market. And then they found that when they take money out, if they need it, they're going to be borrowing from the IRS, which means that was money you would have owed the IRS because you've been writing it off. So they didn't want to borrow money from the IRS, and they didn't want their money lost on the stock market. So I told them, look, keep your matching money because that's free money. Everything over that, diversify and put it into an index universal life because it made sense for this couple. Now, I don't give everybody that advice, but this particular couple, it made sense. Okay. So they each took $700 a month, kept their 401k, and just took $700 per person and diversified it. The life insurance instantly gave them $1 million worth of life insurance. So if Barbara died, David would get $1 million. If David died, Barbara would get $1 million. So it would make any one of them a millionaire, tax free. Okay. We structured it so that at age 64, they can stop putting money into it. And it'll begin to pay them a lifetime tax-free income of $5,122 per month for the rest of their life. Now, say they would have put this in their 401k. Well, they would have lost 30% of it to taxes off the top, maybe 50%, depending on their tax bracket. So they would have lost 30% to half the value of their account as soon as they started to touch it. Then their company would have said, you can take the lump sum or you can take the lifetime income, but you can't have both of it. And either way, they would have lost money in taxes, right? So by diversifying, now they have a choice. At age 64, they can continue to take that $5,122 a month, but they can go back in there and borrow or withdraw $307,310. If they can continue to take that $5,000 a month and leave their cash value alone, and then at age 83, they'll have over $1.2 million that would have regrown because we allocated it so that it keeps growing back and growing back inside their policy. And it also has living benefits too: terminal illness, long-term care, critical illness, and critical injury. If the doctor told Barbara she had breast cancer, or Dave that he had prostate cancer, or told them if he was in a car accident and was burned severely, or suffered head trauma, or was severely burned, if one of them came down with cancer, heart attack, had a heart disease or a stroke or kidney disease, they can file a claim against the $1 million death benefit, and the life insurance company will surrender the $1 million and pay them $800,000, up to $800,000, and to keep $200,000 back for death benefit. So if that was a lot of information, just book a Zoom call with me. If you think you're interested in an index universal life for yourself or a child or whatever, book a Zoom call with me and we can break this down to you, okay? But an index universal life, as you can see, you can stop paying into it and it'll pay you a lifetime tax-free income as long as it's structured right, right? You don't want that death benefit eating up all your cash. So it's got to be structured right, all right? So that was a nugget, okay? All right, here's a client of mine who's a nurse. She said, Richelle, I've got $200,000 in a CD and a money market account at the bank. And I don't want to leave it in the bank because it's not growing well. It's just sitting there. It's not doing anything. And I know when I die, the bank is going to freeze my bank account. And then they're going to give all the money to collectors and taxes and anybody else. I was married 5 years ago, and I don't know whether my ex-husband is going to come and get the money. So I need to get it out of the bank. And she said, I got 3 grandchildren, and I like to give them enough money to go to college as well. But I'm in my 60s, And I know that's going to cost me a lot of money. I say, man, I got you. So this was the right solution for her. She transferred $200,000 one time and put it in an index universal life policy. Boom, it instantly created $588,704 worth of life insurance. She doesn't have to put any more money into it. She sits it and lets it cook. And in the fifth year, it's going to pay her $1,200 a month for the rest of her life, and it's going to grow cash value in the background. It's also going to give her long term care, $6,744 a month, cancer, heart attack, heart disease, stroke, kidney disease, critical injury. If any of those things happen to her, her policy is going to pay out over $360,000. So she can leave $200,000 back for her grandchildren and take $300,000 for herself if the doctor told her she had a critical or chronic injury or illness. This was her solution, right? So it takes a financial planner to see if that's a good fit for you, right? So that's an index universal life. Now we're going to do one last thing, okay? We're going to talk about growth accounts, annuities, the sexy stuff, right? But before we get into that, there's going to be a challenge after this slide, so pay close attention, all right? There are three different types of annuities and growth accounts. There are three different types of accounts. The first type is called a fixed annuity or a fixed account. This is an account where you're paid one flat interest rate and that is it, no more. Okay? It's an annuity that only will pay you 3% interest. You'll never get higher than 3%. You'll never get lower than 3%. Or they'll say it's paying 5%, and that's it, a fixed interest rate. Okay? We call this flatlining in the industry because most of the time it doesn't keep up with the cost of living. So your money's just sitting there and it's not growing very well. A fixed interest rate. The third type of account is called a variable account. This is an account where you're buying stocks on the stock market. So when the stock market earns a lot of money, you'll see it growing really, really well. But when the stock market crashes, you lose your money. Right? So variable, just like it sounds, it goes up and down. These two terms also apply for loans. So if you go take out a loan on your house, you want a fixed interest rate and you want it to be low, right? You never, ever, ever want to take out a variable loan because that means that that company can charge you what they want when they want. You will never, ever pay off that loan. Every time you think you're going to pay it off, they move that interest rate to whatever they want it to be. Okay, that's called a predator loan, right? So fixed and variable. The third type of account is the one that most people never, ever see or hear about. It is a combination of the two. It's called a fixed indexed account. Okay? It is where the life insurance company gives you a guaranteed interest rate so that when the stock market crashes, your money sits on what's called the floor of a guaranteed interest rate. So, for an example of this, let's just say you had money in there and the stock market crashed, you won't lose a dime. Okay, your money will just stay there. But when the stock market goes up, your money grows. So it looks like a staircase. It's called a fixed index account. It has a fixed interest rate and it has stocks in there. Stock market gains and zero losses. Three different types of growth accounts. All right. Now, Miss Linda, you cannot win again. You already got your prize. So if Claudia and Jackie are still on here, I have a question for you. When it comes to your retirement money, which one do you feel is the best type of account and why? Okay. When you're talking about your retirement, so you're talking long term. Claudia, your hand popped right up. All right, go ahead and unmute her. Tell us why you think which one is the best type of account for your retirement money and why. Go for it.
Uh, I think it would be the fixed index accounts because you don't lose money. So when the
Mm-hmm.
stock market still goes up, you still make money.
Beautiful. Excellent. Everybody give her a cheer. Yay. Give her some hearts, y'all. Yay. Perfect. That's the perfect answer. Absolutely right, Miss Claudia. So when the stock market goes up, you have a chance to earn 5%, 7%, 20. I've seen them at 26% inside of elite annuities. But when the stock market crashes, you might earn 1%, or your money might just stay still, but you won't lose a dime. This accelerates the growth of your money. Do you know the reason why people have 401ks and then they still retire and don't have enough money? Is because year after year, they just kept losing money on the stock market and they were never able to recover or stand still. If you take away the stock market losses, you're going to triple your money. I talked to a lady who was forced to retire from the IRS. She worked there for 30 years. She had $600,000 that she saved in her thrift savings plan. And people say, oh, she did good. But 30 years to save $600,000? She didn't do good. Why? Because every 10 years, your money is supposed to double. So think about doubling every 10 years. She should have been sitting on $2.5 million, but she only had $600,000 in there. All right. So the potential of what you could have had by taking away the stock market losses is exponential. All right. So you're absolutely right. You get an A plus on that challenge. Good job. All right. So this is an example of a client of mine. She lives in Norfolk. She retired from the Norfolk Public School systems, I want to say about 7 years ago. She said, Richelle, I don't speak the language that good, but her culture, she was taught to live below her means and save. So on a teacher's salary, after working for 20, a little over 20 years, she had managed to sock away over $500,000 in her 403B. She met me. She said, Richelle, she went to our Be Your Own Bank workshop. And she said, Richelle, I'm losing money because of what's happening with the market, and I can't afford it. This is all I have. I said, let's put your money into an annuity, a fixed index account. She didn't have much saved outside of the 403B. So she only qualified for a 10% bonus. But guess what? She was grateful because the life insurance company paid her $50,000. She said, Richelle, I only made $65,000 as a teacher. So they paid me almost all year worth of salary. I said, yes, ma'am. So her account, when we opened up her portal said $550,000. Now, she stayed with me for 1 year, and I said, when would you like to turn this into an income? She said, I want to turn it into an income next year. You have to wait 1 year so that the bonus money is vested, right? So we waited 1 year. During the course of this past year, the tariffs hit. The stock market crashed and we almost went into a recession. But my client earned a consistent 5 to 10% because there was a floor or a guaranteed interest rate on her money. So that when the stock market crashed, she earned about 1 or 2%. But when the stock market went into a bull and the market went way up, she ended up averaging another 10.41% on her money. So altogether, last year, she earned 20.41%. So we ended the year at $602,057.43. And she said, okay. She took me out to lunch at the Norfolk Pier, right? Because we don't charge broker fees. And she was grateful. I said, okay, it's time to turn on income. And just about, I want to say November of 2025, we turned on an income for her of $47,600.17 per year. So now she has that 403B paying her $47,000. She has her Social Security paying her whatever that is, and she has her pension from the Norfolk Public School System. She is just about at $100,000 per year. She said, Richelle, because of you, I am now financially secure. So now she can go back to China. She can travel. She can do whatever she wants. She's healthy. She's financially secure. She doesn't ever have to worry about running out or pinching again. All right. So this is two strategies. The first strategy is a growth account, the fixed index account. The second strategy is an annuity. And this is a small bonus. All right. All right. So what is a fixed index account? And what is a fixed index annuity? I'm not going to give y'all that challenge. I'm going to spare y'all, but just remember that it is an account that has a floor, which is a guaranteed interest rate. So when the stock market crashes, you don't take those losses. But when the stock market goes up, you get the growth. Okay? All right. All right. So we work with that first bucket. The last thing we want to tell you, and this is a nugget for you, you want to have two income buckets. An annuity that, not your regular annuities, not a fixed annuity that doesn't pay you good interest, not a variable annuity where you'll lose your money on the stock market, but you want a fixed indexed annuity that pays you a bonus that will excel your money, right? You can put money in there every month. You can roll a lump sum in there or however you get it. But at some point in time, you want to turn on passive income and just let it pay you for the rest of your life so that your money never runs dry. Alongside that, you want to put your money in dividend paying stocks. Okay? These are investment stocks. Coca-Cola, Visa, Exxon. We have a list of those we recommend that are old dividend paying stocks that have been there for a long time. They will go up and down, but they won't go away because they've been there for over 100 years or 50 years in some cases. Okay. If you want those, I can get those to you. Okay. Now we looked at, if you only have 3 months worth of savings and you want an annuity, you saw where my client got a 10% bonus and she still ended up at over six figures. Now, if you have 6 months or more worth of savings, you graduated into the high bonus paying annuities. You are in the elite annuity category, and this is what is available for you. There are two types of annuities that are available for you. The first one is called a growth annuity. This is a cash account that will allow you to take, what does that say? Free partial withdrawals. Just like you withdraw money out of a money market or a high yield savings account. There are accounts where you can take free withdrawals within the first year. Right after you get that bonus, you wait 30 days and you can start withdrawing money. There are some where you have to wait 1 year and let that bonus money be vested. Then you can start taking withdrawals. This is a client of mine who actually worked as an IT director at JP Morgan. She had $400,000 in her 401k. She also had 6 months worth of savings in money market, life insurance cash value, because she was my life insurance client for 6 years, right? So we have long-term relationship. So she had cash value in her policy. She had cash in the bank, and she had CDs. She even had some money market accounts where she was doing some things there. I mean, not money market, but a brokerage accounts. So she's a saver, right? On top of the $400,000 that she had in her 401k. So she qualified for how much is that? 20% bonus. I think it was a 20%. This particular double A rated life insurance paid her $108,000 bonus. This company required she wait a year and then begin to take free withdrawals. And she was all right with that. When we opened up her account after she earned her market growth, she earned another $954 on the market. So we looked at her account, it was at $520,954. She said, Richelle, I said, you can start taking free withdrawals. You can take up to 10% free withdrawals. Okay? If you go past 10%, you're going to take a penalty on your bonus money and your principal. If you want to know more about that, jump on a Zoom call or a Zoom call with me and I can break it down to you. I said, if you don't take any money, if you wait 2 years, you'll be able to take 20% free withdrawals. Okay? She'll be able to withdraw from her accumulation value 10 to 20%. She said, Richelle, I don't need to touch this money. I'm still working here at JP Morgan. I'm going to sit and when I at age 65, I'm going to take my Social Security. I'm going to take this 401k money together. And I said, if you do that, then you can start just taking cash withdrawals. She said, I don't want an annuity. I just want to be able to go in there and take money as much as I want without penalties because my son and I are going to start purchasing real estate. We're going to go and just start flipping property. So I need to be able to get more cash on hand. I said, well, this works for you. The annuity will limit how much you can withdraw. You turn on an income, there it is, right? But this account will allow you to get your hands on more cash. So this is the right solution for you. All right. So we said, listen, if you start taking 7% free withdrawals, you'll never run out of cash. This is what it'll look like for the rest of your life. Because of the way we allocate the money, which means the indexes we have, the floor, which is the guaranteed interest rate, you can take out 7 to 20%, just keep flipping it over and over again. Keep growing it. Keep that bonus moving forward. Okay? Beautiful, beautiful, juicy, juicy, juicy. Okay? Okay? Last thing. I know this is a lot of information. If you want specifics and a breakdown, you need to air it out and digest it. Take it in, book a call with me. Okay. If you want, I will gift you the slides in the form of an ebook. Miss Linda, I will create an ebook out of these slides, and that will be my gift to you. Who else wants something? Claudia, you won something, right? If you like, I can create an ebook out of these slides and I can gift that to you. So that way you can look and just kind of chew it up, right? That's good. Okay, so that'll be a good gift that I can give to you. Okay. Who on here didn't get something? Jackie, you still on here? You still get a chance. Okay. So this is an annuity. Okay. This annuity, the lady I told you about who was forced into retirement from the IRS, this is her. Of course, as a financial advisor, I can't tell you her name and too much, right? But this is her. She took that $600,000 from that thrift savings plan, and the company paid her a 30% bonus on her income driver. So when we opened up her account, hear me when I'm saying this. Her account has set up $780,000. She sent me a bouquet of flowers for Christmas. She calls me all the time. She refers me to everybody and their cousin. At the end of the year, the way we structured this is predicted to earn another $4,875 from the market. This particular company has a group of indexes, JP Morgan funds. I put it out there. My team would probably kick me under the table, say you talk too much. But this has a JP Morgan indexee where if you hold your money in that fund and don't touch it for 5 years, they'll double the value of your income. So that's why you see we have a little bit of S&P 500, Russell 2000. So she's getting small growth, and then every 5 years, boom, double. Grow small, boom, double. And that worked perfectly for her. She said, Richelle, I'm going to teach for about 5 years. I'm just going to teach, substitute teach. Then I'm going to turn on my Social Security and this. And at age 65, I said, guess what? With that income doubler, you're going to be at $100,000 a year. And then it's going to grow and then it's going to double and double and double and double every 6 year. In the 6 year of this annuity, your income will exponentially multiply. That is called an elite annuity. This particular annuity was isolated out. It was segregated away from people who have less than $500,000 in assets. But this annuity is available for anyone that has at least, write this down, $25,000 that they can roll into it and still keep 6 months worth of savings in their bank account. Again, if you have $25,000 that you can put into this annuity and still keep back 6 months worth of savings in your bank account, you can get this elite annuity. There's no broker, no financial advisor anywhere who has access to this who will ever tell you that. Only me and Bill. Nobody else wants to give it to you. Work for it. Love on you. If you don't have at least $100,000, or some brokers leverage it at 100,000 or they won't talk to you. Some go 500,000 and they won't show it to you. But we don't participate in that type of financial segregation. 25,000 and 6 months worth of savings, and you are in. I hope you pick up the vibration of truth and power that I'm telling you. Okay? All right. All right. So I'm going to do this last little challenge and then we're going to be out of here. Okay? So there are two types of annuities, elite annuities. The first one is a growth annuity. It allows you to take cash, free withdrawals, 10 to 20%, just like you were withdrawing out of a bank account. The bonuses start at 20% and they go all the way up to 27% on the cash growth annuities. So if you think I just want to be able to get that cash and keep it in there and keep flipping it, right? Then that's the one for you. That's called a cash growth annuity. The second one is an income annuity. Notice here, she turned on $100,000 a year, but what happened to her big balance? She ran out of money. There's no more money to take large withdrawals from. But her income is guaranteed by the life insurance company. Triple A rated life insurance company. You'll see they sponsored the Olympics this year. I'm gonna give you that little note. That's a little hint. Look who's one of the companies that sponsored the Olympics. That's one of the companies. They give her a guaranteed lifetime income. Oh my goodness. Okay. So when her money would have ran out, she is paid and paid and paid and paid and paid. You hear me? So one is an annuity and one is a growth account. So here's my trivia question for you. There are two types of annuities. Miss Jacqueline, for a copy of these slides in the form of an ebook, tell me what are the two types of elite annuities? And tell me a couple of features of them so I know that you got it. Tell me the two types of elite annuities. Is she still here?
She had to drop off.
Oh, okay. If we reach back out to her, let her know that we're taping this and we can send her a copy of the link. Once we edit it, okay, we can send her a copy of the link. Okay? All right. Okay. All right. So, with that being said, what is your next step? Your next step is to book a 30 to 45-minute coaching session with me. This is where we get on a Zoom call, or if you live in my area, Miss Linda, we can meet after my class at Prime Plus sometime or what have you, and we can just talk, me and you, about what your goals are, how you see that one of these products can fit into your plan. Now, we can do a planning session where we fill out something called a green sheet. This is where we plug your numbers into a specially designed Excel spreadsheet, and it will help us find money to get you qualified for one of these accounts. Just to sit down with a financial planner, just to do that, nothing else, it would normally cost you $2,000 to $5,000, depending on how intricate the plan is. So you're probably saying, well, what is your fee? I can't wait to tell you, okay? If you need a Roth IRA or you think the Index Universal Life would be a better option for you because you need to get your money away from the tax man. You need a place where you can save it and the tax people can't touch it and you're healthy, so you think you could get an Index Universal Life? We can talk about that and structure one for you. This is going to put an extra $20,000 into your pocket. Just talking about tax strategies and tax-free strategies. We can even chat about, what do you call them? Trust. And we can point you in the right direction to lawyers here in Virginia Beach, Norfolk, Maryland, D.C., and Virginia. We have access. We can point you in the right direction. Just giving you those tax strategies. That's a value of at least $20,000 or more. We can help you convert your life insurance into something that has cash value that lasts for the rest of your life. Most people have term life insurance. So when they leave their job, they don't have any more life insurance left. We can talk about converting that policy to a cash life insurance policy. Okay? You have direct phone access to me and Bill. How much is that worth? That's priceless. But financial advisors normally cost $20,000 per year or more, and they take a fee out of your annuity or your brokerage account of 2% to pay their fee. If you look at those illustrations, you will not see a broker fee on them. We don't charge any broker fees. Okay? Well, how do you get paid? The insurance and the investment companies pay us a small fee. They pay us. Not as much as they pay you. You're going to get paid more than us. I wish we got paid 30%. Okay? But they pay us, but also we don't charge you a brokerage fee. We could, but we don't. Our value to you is it worth at least $55,000 or more into your pocket, minimum. So, what is our fee? Referrals. Who do you know that we should know? We ask you before we show you the money and get a life insurance company to pay you this huge bonus into your account, we ask that you refer us to someone. And we do this the professional way. We ask that you text them a copy of our business card and let them know that you decided to work with us and that we're very good, right? After you contact them, then we will contact them. Our fee is 10 referrals, okay? And we'll ask you to do that once you feel comfortable with it. So that will be the exchange instead of a broker fee or an upfront fee. Book your session today. Now, this is my cell phone number. I'm fine with that. If you want to text me, you can do that. There's my number. And we can talk on the phone. If you want to do a 30-minute Zoom call, Keisha, you can drop the link in the chat for the tiny URL. You can do a Zoom call. Okay? All right. All right. All right. So now I know it's late and I appreciate your time. I really, really went over, I guess, because I feel love for you all. Okay. Are there any questions about anything? Remember, don't expose any financial information about yourself. But are there any questions or any slide that you want me to go back and answer before we go? If so, raise your hand or let me know in the chat and Keisha will help pin you. I see you talking, Miss Linda. Want to raise your hand? Yes, ma'am.
I just had a question about that you had talked about equity in the house. And
Mm-hmm.
that's just a concept that I'm still trying to understand because I have never used the equity in my house
Mm-hmm.
and it's paid off. And so I guess that means I have a lot of equity, but I've never
Yep.
used it because if for me, it
Mm-hmm.
meant taking out a loan that I would have to pay back. So isn't that just the gist of it? You're taking out a loan on your own money
You are using the equity in your house as collateral
that you pay back.
for a loan. So let's
Yeah.
say you have $100,000 in equity in your house
Mm-hmm.
and you want to take a $50,000 loan out to do whatever. You see how much, you don't go just to your bank. You want to shop and see who's going to pay you the lowest fixed interest rate. So once you find that, and there are a couple of resources, once you find, let's just say, um, Capital One is going to offer you a $50,000 loan at 5% fixed interest, right? So they offer you that loan, and if you don't pay back within 24 months, whatever you don't pay back, they'll decrease from the equity in your home. If you pay it back, your credit is going to go on steroids. They're going to want you to do it again, right? So you only borrow what you know you can pay back. And
Mhm.
if you don't think you can pay it back, then you know that's going to decrease the equity in your home. Does that make sense?
So therefore, if you don't borrow it if you know you're not going to pay it back.
If you know you're not going to pay it back, it's going to go against the equity in your home,
Right. Hmm.
right? So
Okay.
that's but you don't borrow it, but you do borrow it if that money is going to make you more money. So if you have debts, like some people have a lot of debts, and if you pay off those debts, your credit score is going to go up to 600 or 700. And that's going to open up more opportunities. Like you might have a student loan or whatever. So you're going to use that equity in your home to eliminate debts,
Okay.
right? You're going to use that equity in your home to buy another home that you're going to rent,
Hmm.
right? Or you're going to use that equity in your home to as an asset. You have to borrow to put that money into an asset, right? So that's the be your own bank strategy, not borrowing money to put it into a decreasing asset. There's two type of asset. There's assets that depreciate in value. So a car, clothing, furniture, home improvements wear out with time. Things that depreciate in value with time,
Hmm.
right? And then you put it into things that increase in value with time. So it's borrowing money to make money. Being your own bank is borrowing money to make money. Disney borrowed $100,000 from his life insurance policy at 3% interest, purchased the property in California, and when Disney opened, it made $2.5 million. So he paid back the 100,000 at 3%, and 3% was like the interest was like a tip,
Flow. Hmm.
right? That's being your own bank,
Hmm.
right?
Okay.
Yes. Good question. Excellent question. Any other questions?
Time, but we can make an appointment for a Zoom call.
Yes. Did you click the link in the chat, Keisha?
Yeah, the links in the chat. There's two of them.
Yep. If you click the link, Miss Linda, you'll see my schedule open up.
Oh, I see. Okay.
Mm-hmm. And go ahead and pick any time you want. Type in your name, your email address, and then where it says, how did you
I
hear
don't
about
right.
us?
I
You
don't
see
see
it?
where it. Mm.
Okay. So yeah, go ahead and type in your name, your email address. And where it says, how'd you hear about us? Put the BYOB, which means be your own bank. So I know that you were on this workshop. Okay. Well, love and blessings, everyone. Big kisses. Mwah. Jump
Thank
on
you.
here anytime you want, anytime you see a link.
Hmm.
This is not a one and done. We're working to do these every week, and I apologize for going so late, but I think my love just drives me to talk too much. But all right, but I will see you. And Miss Linda, I look forward to talking with you one on one, and we're going to see each other next week. We see each other
Okay.
all the time at the center.
Hmm.
All right,
Yes.
love and blessings,
Sure.
everyone.
Thank
Talk to
Good
you
you.
Good
later. Thanks
night.
for
evening.
hanging in
Bye.
Good
Uh,
there.
night.
Bye
thank
bye.
you.
Thank you,
Good
Keisha, for
night.
staying so long.
Yeah, my
All right.
pleasure. Have a good night, everyone. Thank
Bye
you.
bye.
All
Thank
right.
you. Good
Bye-bye.
night.